I've been watching financial systems long enough to recognize the difference between noise and signal. Markets panic loudly, politics screams constantly, but when institutions move in silence, that's when something real is happening. And over the last 48 hours, something extraordinary happened almost without anyone noticing. Several of the largest banks in the United States made the same decision, independently, within the same narrow window of time. They didn't issue dramatic press releases. They didn't argue publicly, they simply acted. Business relationships were terminated, accounts were closed, credit facilities were not renewed, future transactions were declined, no freeze, no temporary restriction, no pending review, just termination. This is not a story about politics in the conventional sense. It's not about ideology, elections, or tribal loyalty. This is a story about how modern finance actually works. And what happens when the system decides someone is no longer worth the risk? Because once that decision is made, wealth doesn't protect you, fame doesn't protect you, assets don't protect you, and that's the part most people don't understand. Banking is not a right, it's a privilege. There's a comforting myth that access to banking is automatic, that if you have money, banks will always want you, that financial institutions exist to serve customers no matter what. None of that is true. Banks are private entities. They are not public utilities. They are not required to serve every client. Their primary obligation is not to customers. It's to regulators, shareholders, and the stability of the institution itself. Every banking relationship is contractual, and almost every banking contract includes the same clause. The bank may terminate the relationship at its discretion, provided funds are returned. No court order required, no explanation required, no appeal guaranteed. When banks decide a customer represents excessive regulatory, legal, or reputational risk, they don't negotiate, they exit, quietly, decisively. Why this is different from frozen accounts. Most people confuse debanking with frozen accounts. They are not the same thing. A frozen account still exists. The relationship remains intact. Transactions are paused while legal or regulatory questions are resolved. If the issue clears, normal activity resumes. Debanking is final. The account is closed. The relationship ends. Funds are returned, often by paper check. Future services are refused. Once debanked, you are no longer a customer. You are an outsider. And restoring that relationship is extraordinarily rare. Why banks walk away, even from powerful clients? Banks manage risk the same way insurers do, not by guessing what will happen, but by deciding what they refuse to be exposed to. There are 4 kinds of risk banks fear most. 1. Regulatory risk, scrutiny from oversight agencies. 2. Legal risk, lawsuits, investigations, enforcement actions. 3. Reputational risk, brand damage, customer distrust. 4. Operational risk, internal compliance failures. If a client triggers too many of these at once, the math stops working. The revenue from the relationship no longer justifies the downside. And here's the critical point. Banks don't need proof of wrongdoing to exit. They only need to believe the risk has become unacceptable. Why collective bank exits matter. One bank walking away is survivable. 4 major banks walking away in rapid succession is something else entirely. When multiple institutions independently reach the same conclusion at the same time, it sends a signal throughout the financial system. Risk committees talk, compliance databases update, regulatory attention spreads. Any new bank considering taking that client sees the same red flags immediately, and then they ask the only rational question: if the largest, best-resourced banks decided this relationship wasn't worth it, why should we take the risk? The answer is obvious: they don't. What happens when banking access disappears? Modern businesses do not run on cash. They run on infrastructure. Without banking access, a company cannot process payroll, accept credit or debit card payments, send or receive wire transfers, pay vendors electronically, service loans or mortgages, maintain credit lines, pay taxes efficiently. This isn't theoretical, it's mechanical. No bank account means no operational flow. And when operations stop, collapse doesn't come from lack of assets. It comes from lack of function. That's why debanking is often described not as punishment, but as operational death. Why alternatives don't save you. Some argue there are workarounds: cash, fintech, cryptocurrency. At scale, none of them work. Employees expect wages in national currency. Vendors require electronic settlement. Taxes must be paid in dollars. Fintech platforms depend on partner banks. Crypto must be converted through banks. Every path leads back to the same gatekeeper. The banking system, the uncomfortable reality. This is the part people struggle to accept. Modern commerce is permission-based. Participation depends on trust. Trust depends on compliance. Compliance depends on perception. When institutions decide you threaten the system more than you benefit from it, the system removes you. Without drama, without delay, and without apology. That's not conspiracy. That's risk management. And once that line is crossed, money alone cannot buy your way back in. One of the biggest misconceptions people have is believing banks act in isolation. They don't. Modern banking operates inside a dense web of shared information systems, regulatory reporting, and professional networks. When a major institution exits a client, that decision doesn't stay private for long, even if no press release is issued. Here's why replacement banking becomes almost impossible once multiple exits occur. Every bank runs mandatory KYC and AML checks, know your customer, and anti-money laundering procedures. These systems pull from regulatory watch lists, adverse media databases, risk scoring platforms, politically exposed person registries, prior account termination signals. When a client applies to a new bank after being exited elsewhere, the system doesn't start from zero. It starts with context. Recent account closures at major institutions immediately elevate a client into a high-risk category. Compliance teams see that others already walked away, and that alone triggers enhanced scrutiny. And enhanced scrutiny is where deals go to die. Why smaller banks say no, even faster. Some assume regional banks or credit unions might step in. In reality, they're even more cautious. Large banks have armies of lawyers, compliance officers, and regulators embedded into their operations. Smaller institutions don't, which means they cannot afford mistakes. If a regional bank accepts a client rejected by global institutions, regulators don't applaud them. They investigate them. The first question regulators ask is simple: why did you accept a client everyone else refused? And unless the bank has an airtight, documented, risk-based justification, that question turns into a problem. So instead of gambling their charter, smaller banks decline, often within hours. Not because they're told to, because they understand the consequences. Why fintech isn't an escape hatch. Fintech companies look like banks, feel like banks, and market themselves like banks. But they are not banks. They rely on partner banks to hold deposits, clear payments, and settle transactions. If partner banks won't touch a client, fintech platforms can't either. Payment processors, digital wallets, merchant services, all of them ultimately route through regulated banks. If the core system rejects you, the satellites fall away automatically. The cascade effect nobody talks about. Debanking doesn't destroy a business instantly. It triggers a chain reaction. First comes cash flow disruption, then payroll delays, then vendor refusals, then service interruptions, then loan defaults, then legal exposure. Each stage accelerates the next. Employees don't wait long when paychecks fail. Vendors don't deliver without payment certainty. Lenders don't negotiate when contractual obligations aren't met electronically. What looks survivable on paper collapses in practice, not because assets vanished, but because coordination did. Why courts rarely intervene. Many assume the legal system can force banks to reverse course. It can't. Banks are private entities. Courts have consistently ruled that, absent illegal discrimination, banks may choose their clients. Risk assessment is considered legitimate business judgment. As long as funds are returned and contractual notice requirements are met, courts defer to the bank. There is no constitutional right to a checking account. There is no statutory guarantee of banking access. There is no legal mechanism forcing a bank to take risk it rejects. This isn't a loophole. It's how the system is designed. The larger implication most people miss: This story isn't really about one organization, it's about power. Not political power, but infrastructural power. The power to decide who participates in modern commerce. Banks don't need to accuse. They don't need to convict. They don't need to persuade the public. They only need to decide the risk isn't worth it. And once that decision spreads through the network, exclusion becomes total. The final question. This moment forces an uncomfortable realization. In a modern economy, survival isn't about how much you own. It's about whether the system still allows you to operate. Banking access is the invisible permission slip for everything else. Lose it, and nothing else matters. Not buildings, not brands, not wealth, only access. Whenever debanking stories surface, someone always says it, why not just operate in cash? That idea collapses the moment you scale past a street vendor. Large businesses are structurally incompatible with cash-only operations. Not inconvenient, incompatible. Paying thousands of employees in cash creates security risks, accounting violations, labor law violations, tax exposure. Most jurisdictions legally require traceable payroll records. Cash payments trigger audits almost immediately. Employees also don't tolerate it, not in modern economies. Now add customers, hotels, offices, clubs, properties, services customers expect, credit cards, online payments, electronic invoices, cash-only businesses hemorrhage revenue overnight, not gradually, immediately. And then there are lenders, mortgages, commercial loans, credit facilities, all require electronic settlement. Contracts specify wires, ACH transfers, and escrow-controlled accounts. Miss those terms and default is automatic. No bank access means no payments, no compliance, no negotiation. Why crypto doesn't save you either. Cryptocurrency sounds like a workaround until reality intervenes. Yes, crypto can move value without banks. No, it cannot replace banking for real businesses. Here's why. Employees want dollars, not tokens. Taxes must be paid in national currency. Mortgages require fiat settlement. Vendors demand bank transfers. Accounting standards require stable currency. Even converting crypto into usable money requires, you guessed it, banks. Exchanges depend on banking partners. Without access to those partners, crypto becomes a locked vault with no exit, and volatility alone disqualifies it for payroll, budgeting, and contracts. Crypto may work for individuals. It does not work for large-scale operations. The psychological shock inside organizations. One underreported consequence of debanking is internal collapse. The moment financial access becomes uncertain, executives panic, vendors demand upfront payment, employees start job hunting, lawyers prepare for damage control, confidence evaporates, and business runs on confidence more than cash. Once trust breaks, internally and externally, recovery becomes nearly impossible, even if a theoretical solution appears later. Why this is so rare? And so, final banks don't do this lightly. Terminating a major client creates risk for the bank itself, lost revenue, political pressure, media scrutiny, legal threats. So when multiple institutions independently reach the same conclusion, it signals something deeper than ideology or optics. It means the cost of keeping the relationship is higher than the cost of ending it. That threshold is extraordinarily high, which is why, once crossed, it almost never reverses. The invisible verdict. No charges are filed, no trial is held, no judge speaks. Yet the outcome is decisive. Debanking is not punishment in the legal sense, but it is exclusion in the operational sense. It doesn't declare guilt, it declares unsustainability, and in modern commerce, that distinction doesn't matter. The real lesson. This story exposes something most people never think about. Economic power today is enforced not through laws, but through access. Access to systems, access to infrastructure, access to trust networks. Lose those, and everything else becomes irrelevant. That's the quiet reality behind modern finance. And once you see it, you can't unsee it. At this stage, many assume courts can fix it. They usually can't. Banking relationships are governed by private contracts, not public entitlement. As long as a bank follows notice requirements and returns funds, courts almost always side with the institution's right to disengage. There is no constitutional right to a bank account. There is no guaranteed access clause. There is no obligation to maintain a relationship deemed risky. Even lawsuits, when filed, take years. Operations collapse in weeks. And by the time a judge hears arguments, the business ecosystem is already gone. Why someone will eventually bank them is a myth. People underestimate how interconnected banking really is. Risk systems talk to each other, compliance officers talk to each other, regulators talk to everyone. Once multiple major institutions flag the same client, that information becomes industry knowledge, even without formal coordination. A smaller bank stepping in wouldn't be bold, and it would be reckless. And reckless banks don't survive regulatory exams, so the door doesn't reopen quietly. It stays closed everywhere. What actually ends businesses in the modern era? It's not lack of assets, it's not lack of customers, it's not even lack of money. It's loss of infrastructure access. Modern business is a layered system: banking, payments, credit, compliance, trust. Remove the first layer and everything above it collapses automatically. No villain, no drama, just math, the uncomfortable truth. This is why debanking feels shocking, not because it's illegal, not because it's dramatic, but because it reveals who really controls participation in the economy. Not politicians, not courts, not voters. Systems do, and systems don't argue. They simply stop responding. Final thought: you can survive bad press, you can survive lawsuits, you can survive debt, but once the financial system decides you are non-operable, survival becomes theoretical, not practical. That's the real story here: not politics, not personalities, access. And once access is gone, everything else becomes noise. This moment isn't isolated. It's a warning shot for every high-profile business, political figure, and corporation operating under the assumption that scale equals immunity. It doesn't anymore. Banks no longer ask, "How powerful is this client?" They ask, "How expensive could this client become?" Regulatory fines don't care about fame. Reputational damage compounds instantly. Risk models don't negotiate. And once risk crosses a threshold, wealth becomes irrelevant. The shift most people missed 20 years ago: influence protected access. 10 years ago, size still mattered. Today, compliance outweighs everything. Banks are no longer relationship-driven institutions. They are risk-filtering machines. If your presence increases, audit exposure, regulatory questioning, media scrutiny, legal uncertainty, you are no longer a client. You are a liability. Why this is becoming more common? Three forces are converging. 1. Regulators punish banks faster than ever. One investigation can wipe out a decade of profits. 2. Reputation now spreads at algorithmic speed. Banks can't afford to wait and see anymore. 3. Financial infrastructure is centralized: payment rails, clearing systems, compliance software. They all funnel through the same choke points. When those choke points close, alternatives don't scale. The illusion of alternatives. People love to say they'll find a workaround, but workarounds don't pay. Thousands of employees, commercial mortgages, insurance premiums, taxes, international suppliers. Workarounds operate on the margins. Large businesses operate on rails, and rails belong to banks. What actually survives debanking? Historically, only 3 models survive long-term. 1. Radical downsizing: shrink until banking needs disappear. 2. Jurisdictional escape: move operations into countries with different enforcement norms. 3. Institutional collapse followed by asset liquidation: properties sold, staff gone, brand hollowed out, none preserve the original structure. The core lesson: modern power is not about money, it's about system compatibility. You don't need permission to speak, you don't need permission to own assets, but you do need permission to transact. and permission is conditional final line, the one that lingers. In the modern economy, you're not destroyed by enemies. You're removed by systems that simply stop recognizing you. And once that happens, nothing you say or sue turns the system back on.